options of the day of expiration, 0 DT, can give a capital efficient...
Hammer don't hurt him, but whatever.
Trading options on their day of expiration, 0 DT, can give a capital efficient way to get a high degree of exposure to the market and stay engaged throughout the day. But learning what mechanics are best when making such trades requires a mixture of new experience and new data. Initial results suggest that it was beneficial to manage winners much more rapidly for 0 DT trades than for 45-day trades. So let's see how this plays out for management based on duration. Okay?
Okay.
Management, this is on duration. Let's go next slide. So, using 57 trading days of intraday data in the SPX collected every 10 minutes, considered beginning each day by selling a 0 DT $30 wide iron fly, or the same thing we did, which is buying a $30 wide butterfly, which is, in this case, their example here is selling the straddle and buying the wings. We examine the results for traders who recenter this position every 30, 60, 90, or 120 minutes, as well as one who simply held through expiration. For example, the 30-minute trader placed 13 trades in a typical 6.5 hour market day, while the 90-minute trader placed 5, with the last one only being on for 30 minutes. All the trades were assumed to exercise at mid-price. That means just assume to fill at mid-price.
Right.
Okay.
Which is a little bit of an assumption, right?
Because we can't assume slippage, right? We can factor in costs in here, which we did, but we can't assume slippage.
Right.
Let's go next slide. So first thing, okay, and again, this is really interesting. Now I just did this trade about 30 minutes ago, so we're going to see, and the market's had a nice rally since then. So let's just see one thing for a quick.
Well, it was up. You did it at 13.95. It's 13.60 right now, and it was trading at 14.40 or so.
Yeah, so it's been all over the place. It's been up a little, down a little, right?
Yeah, it's been up $1. I mean, up 80 cents, down 80 cents.
Okay, that's fair. All right, winning trade. So if I take it off after 30 minutes, 61% of the time. All right, 60 minutes, 66% of the time. 90 minutes, 66% of the time. 120 minutes, 63, and then if unmanaged, 51. And that all kind of makes sense to me. All right. But the average P&L seems to be best. I don't know, an hour. It seems like right here, an hour is your window, right?
Yeah, an hour to 2 hours. If you're, I mean, I guess I don't know. Yeah, right.
It's an hour.
If it doesn't work after an hour, you're going to have to go through a little bit of pain. It seems like. Yeah.
It seems, based on this slide, it's an hour. The time frame, we're totally talking about managing by duration. That's it. We're talking about 1 hour, right? 66% win rate, 50 cents in profits. CVAR is 625. That's the worst 5% of the losses. So that makes kind of sense to me.
Yep.
Right? So what time did I put that trade on?
You put that trade on at 8:42.
8:42. Okay.
Right. So you've had it on for about a little over half an hour.
Okay. And
it looks like you're up. Mid price is 14.20, so you're up around your quarter.
Okay. Okay. There you go.
I mean, that's what it is.
I know, it's great. It's fun to see this stuff work in real time. Let's go to the next slide. And I did exactly what this is, a $30 wide butterfly. Let's go to the next slide. I'm sorry, this is the next slide. So
it's looking at average P&L. And what?
No. So we're now, what'd you say?
I said it's looking at the average P&L now. That's the big thing I'm looking at.
Yeah. So winning days. The first one was by trade, right? This is by days. So the winning days, 69, 72, 56. So obviously earlier is better.
Yeah, earlier is better.
That 1 hour is our number.
Yep.
Average P&L, well, 1 hour is your number.
Yeah, for sure. Agreed. When you compare to conditional value at risk, it's half of. Well, I mean, unmanaged is not the play. I mean, so you can't set it and forget it.
Unmanaged is not the play.
Right.
And the reason we did this is because after we did the piece on Friday, everybody wrote to us and said, well, you said to make multiple trades if you get to a certain dollar amount, but shouldn't we be basing this on duration or something else, or where whatever it is? And it looks like here, basing it on the 1 hour time frame is probably or recentering it at 1 hour. Let's call it recentering at 1 hour.
The problem we've seen is when you close this, and it's been very early. I mean, this is the second day of looking at it. What strike do you put on afterwards? I can't with good conscience go back right into the same strike again, especially if it's higher.
Right. But that's the whole thing.
That's what we saw yesterday.
Yes, because I covered it.
Bought it low. You sold it for a nice 10%.
No, I know, but I did it based on price. This is based on time.
I get it. I know, but even by time, so let's say I took this off after 30 minutes and you made your quarter. I'm going to give you a best case scenario. Okay, what do I do now?
Well, you'd go up. This one, you'd go up a strike or two. Because I did it.
I did it. Sure.
Yeah, I did it below the market.
Okay.
Because you told me earlier that we were going down today. So
well, you don't do anything you don't agree with, and it was a difference between 10 cents, by the way.
I'm just saying.
You want $10? I'll give you $10. Is that what it cost you?
I want 20. Let's go to the next slide. So the previous 2 months were very good for short-term delta neutral short premium positions with wings at approximately the expected move. But the degree of management had a large impact on how good we did. So unlike profit target-based management, time-based management does little to affect the percentage of winning trades. But highly active traders those recentering about once an hour still had better profits than less active traders. So even in highly liquid markets, getting an order filled often requires accepting a price slightly off mid-price. The losses to such friction will be roughly linear to the number of trades, which produces an incentive to managing less frequently. For example, skipping a recentering if the spot price is hardly different. See the suggestion here?
No, I'm still trying to read through it.
So what they're saying here in the piece of research and what he's writing is, for example, skipping a recentering if the spot price is hardly different, suggesting that is the one when you skip because it hasn't moved.
Got it.
Zero DT options are an exciting topic that we're still learning about. Remember to maintain appropriate position size and be prepared for potential shifts in overall market behavior. Yes, all those things are relevant. So basically the takeaways from this is that managing by duration was actually pretty effective. But if the underlying hadn't moved, you're probably better off not giving up the slippage to get back in again.
Very good, sir. Beautiful. Even S&P's up 3, NASDAQ down 25, Russell up a big 28, Dow up 6, and volatility sounding up, which is the one caveat we looked at all day that you said it worried you, down 45 cents. We'll be back in 90 seconds. You listen to Tasty Live. We've got, oh joy, my friend, Mr. Scott Sheridan coming in next, Tasty Trade World Headquarters.